In today's video, we are going to take a deep dive into a company that has been punished by the market a lot in the past few years. This company is PayPal, and even though that their fundamentals are looking quite okay, the stock price has been decreasing, and in this year it also has been decreasing. So let's see on what's the future could be for PayPal. Is it undervalued? Where could we see some growth possibilities? And also what the future holds for this company. And we are going to use Metis, which is a fundamental stock analyzer that I have developed. You can check in the description. There are some great features, for example, holding your portfolio, creating snapshot pictures, looking at the bigger macro picture, and of course, screening some ETFs. So if we want to take a deep dive into PayPal's financials, we have to look at the share price, just how it stays as of now. And you could see that in the past 5 years, after the 2022 crash, the stock has been struggling. There has been no very large growth in the past time, so you could see a little bit bigger growth in terms of between 2024 and 2025 beginning. There was a growth of like $30 per share, or a little bit closer to 25. And now you can see that since that high was there, it has been still declining. So the past year was a struggling time for that. Even though the fundamentals were okay, the company was progressing on the goals it has stated, but obviously the market was waiting for something more of a back growth, and so this is the main reason why the company has struggled. And still the analysts are rather pushing it to a hold position instead of a buy position, which is negative for the company. So if we have a little picture about their financials, we could see starting from the left to the right that the revenues has been steadily growing since the past 5 years. There is no extreme growth, and as you can see, the growth between 2023 and the current times is not as much as it was in the previous years. So this could be a reflection point if the company could generate the revenues that you're expecting from it, and we could answer that for most analysts it has probably not, and so this is the reason why have they punished the company. You could see that the gross profit has been rising in the same way. The cost of revenue is also rising, but not in the same way as it has been in previous years. That is leading to a better profitability for the company. So you can see that in the net income, if you're moving down, that their net income is pretty stable, as not as bad as was it in 2022, and the company is becoming or staying very profitable, and we will take a deep dive in that. Let's check the free cash flow because we will need that for the valuation. So if we take out if we check their free cash flow, we can actually see that the company is actually producing a bunch of free cash flow, which is great for our valuation. However, 2024 was better, and then we will see how 2025 and 2026 will be appearing on the companies. We can see that they have been repaying their debt, and also massively repurchasing common stocks outstanding, which could have a positive solution for the stock price in the long run, but obviously it takes a bunch of time. And also they have introduced some dividends, which is not very high, although for someone it could be interesting. You can see that the payout ratio is 2.66 and the dividend yield is 0.24. Obviously they could raise it higher, but I would rather have them reinvesting the cash flows generated or the cash generated, or repaying the debt, which is not a very huge one. So they have cash in hand, and also they are probably gonna increase the share buybacks and also the dividends in the upcoming years. This could have a positive effect on the stock price. If we look at their beta, we could see it's 1.44, which is obviously understandable in terms of volatility. This is a tech company. It's a tech company that has been struggling, so it's either a news can hit it very hard, or it would decline or raise a lot. So we could actually see that in terms of 2025, that there has been positive news. The stock grew a lot, and if there were several negative news, the stock decreased, for example, not hitting the targets that the analysts were expecting, and the 52-week high is 93 and the 52-week low is 55, so you can see in between there is a large gap. However, the stock price for 2026 for these few trading days has been struggling also. So from the 60-ish, we went down to the current price, which is 57. And then we could see actually the cost map for the company. You can see that the net income generation is very nice, even though that it's a generally older company than if we would look at Stripe or other ones. And maybe this is the main reason why the market is punishing it, because the other competitors like Apple Pay, Google Pay, Stripe has been surging a lot, and of course Apple and Google can afford not to make as high margins on their payments because it's in their ecosystem. PayPal's main activity is about generating transactions and in the transactions gaining money. We can see this. The management has already outlined the process where they would like to become again slightly more compatible in these terms. Obviously, it's going to be the long run which is going to determine it. Let's hop on to the valuation, where we are going to do a discounted cash flow and determine what could be the share price, an estimated share price for the fair value of the company. This is where I think it's a great product to have. It's a discounted cash flow model that is simplified. You just have to put in the assumptions. It's already suggesting the WACC you should use. So, for example, it shows 10.6% for the WACC. You can see how the exact calculation has been done. You can see 3 scenarios, and then you can just apply the one which you would like to prefer. For the specific stock, it is suggesting correctly 10.6, and then you would just have to change the projection years. You could either have 10, 5, 3, whatever you think. Set the terminal growth rate, and also just to determine what's going to be the actual free cash flow growth rate. So for this, I'm going to go and stick with the suggestion, and also just going to stick with the average 5% growth here. So we will see on what's the Excel calculation. You can see the detailed version of the valuation, where I'm going to move my head up here so you can see that the projection of the free cash flows are looking like this. Is this realistic? Well, it depends, obviously, how the company is going to perform for the next run. I would say if we look at the average 5-year, we should somewhere ask for this at a minimum. So if the company is not going to be able to provide these growth in the upcoming years or year, and then we could just backtest it and then rerun it and rethink it if the valuation was correct. And let's quickly go to a sensitivity analysis. You can see it in the bottom, where we would take different scenarios, and then we would determine if the possibility is higher than the risk, and we would definitely see, I think, from this that there is a better possibility of growth. However, there is a possibility of decline. For example, if we would just see a 1% increase in their average free cash flow, then you would definitely have around the share price that is currently trading on. So you have to have somewhere around 3%. Let's just play if even the 5-year average is negative. You could see that it is playing with the 1%. If that is happening, you could see a company with this current WACC around $61, which is around now. So if you are expecting that the company is not going to be able to grow its free cash flows, which I think some analysts are doing, then you would see a share price here. But if we look at the average consensus about the analysts, we will look at this at the analysis page also. You would see 73, which is very close where most analysts are putting, which would involve a 3% average growth for the next 5 years, and also a WACC around 8 till 10, but I would rather say on the 9-ish side. So it gives us a picture if there is a better possibility than a risk. I would say that there is more possibility than risk, but this is, however, only my opinion. So the bear case would be that the possibility upside is around 27%. Some people can say it's a lot, some people can say it's not enough. If you're an Nvidia investor, it's definitely not something that you're looking for, but targeting the 3% growth rate with discount rate or a WACC of 10, I think it's appropriate to use. Obviously, we will see, and I'm gonna do another video in July, so we can catch up. In terms of the analysts, you can see that 23 analysts are suggesting a buy, 22 is suggesting a hold, so it's pretty much equal. People are waiting for something to happen, and the target price is around 78. So you could see that where the numbers could be lying in terms of the analysts and also our valuation. So I hope you get a good picture, and I would like to ask you to subscribe, like, and also comment down which stocks I should do in the next one. And also just try Metis. It's a great tool. We have worked a lot on it. You can grab a great price for it in the description. So let's meet in the other video I'm gonna post. And also don't forget to smash like, subscribe, and support my work. See you in the next one. Goodbye.